Hello everyone, hope you're doing well today. Welcome back to my channel. If you're new here, welcome to my channel. And today I've been thinking that I need to cover one of the concepts that I've been mentioning quite a lot of times throughout my videos, but I've never really touched the basics of it because that's a very important topic. Specifically, if you are or you want to be a property investor, this is definitely very crucial to know. So obviously, I'm talking about the concept of property refinancing, which is something that I've been doing quite a lot throughout my investor years. And I think this is something very crucial that people many times misunderstand. They don't know exactly how it is applied and how you can actually benefit of it. And that's exactly why I thought, why not make a video explaining you in details how this actually works and how you can apply it in your property investing journey. And with that, I will also add a couple of examples from Dubai, where I'm currently based. But this concept is actually quite universal and it could be applied anywhere. So if you're interested, stay tuned, leave a thumbs up, subscribe, and let's go. I've been referring to property refinancing in many of my videos as being one of the best strategies that I personally applied towards generating more wealth throughout my property investing years, and that I found the most workable. But what is property refinancing? Because many people speak about this. There are tons of videos and explanations, but do you actually understand this? Well, let's take it from the beginning, step by step, and you will be perfectly sure in this concept and understand the strategy by the end of this video. Generally, property refinancing is the process of replacing your current mortgage with a new one, typically with better terms and conditions. There are four main advantages why people actually look at property refinancing, and these are lower interest rates, reducing monthly payments, switching the loan term, so making it longer or shorter, or the most interesting and probably workable out of all, accessing some of the property's equity as cash. This last concept is also called cashout finance, and this is probably one of the most interesting parts, but I'll get back to this in a second and explain it to you how it actually works. Before that, let's cover the other advantages why generally people take out property refinancing. In simple words, property refinancing actually means that you are moving from this bank where you currently have a mortgage to this bank where you probably have better advantages, benefits, and so on. At least this is what the general public thinks and apply it on a day-to-day basis whenever they see, first of all, that the current market interest rates are lower, and at the time that they got the mortgage with their bank, the interest rates were higher, so they would approach the second bank and tell them that, look, this is the loan that we have, and we want to move to your proposal. If you have one better than our current one, they would offer something, and obviously the new bank would basically cover up your mortgage from the previous bank and offer you a new mortgage. This could also mean that you might have smaller monthly payments, or you would simply have lower interest to pay overall if you stick to that mortgage and you pay it till the end. Also, you can switch the loan types. For example, if you had a fixed mortgage and it's going to become variable after 3 or 5 years, you want to get it back to a fixed rate, then the bank that you're currently banking with and having this mortgage, they will apply the variable interest. And by that time, you probably would think that maybe I will just refinance this, get another fixed rate mortgage, and see maybe the market actually has better offers. So generally, people do this mainly to save their money, to pay less per month, and maybe minimize or maximize the loan term, But these are some of the main benefits. However, there are also some costs implied with this, which many banks don't actually cover and other people also never disclose. But some of the costs that you might incur while doing this, you need to pay for another property valuation. In this case, maybe the property already increased in value, so you will be able to actually get more money or more equity also out of this deal, which is the ultimate benefit that I'm going to speak at the end. However, you need to do that. You need to pay for the new property valuation. You need to pay for the new bank, for the loan processing fees, and many other fees that are involved with this. Maybe you will have to get a new life and property insurance. So you need to take into consideration that, because even applying for a new mortgage, the bank will usually have a smaller percentage that they would apply as a bank processing fee. So if you want to change to a new mortgage and do this property refinancing, then approach the new bank and ask them if they can waive it for you. In such case, you are able to make the decision quicker and more efficient, because if the new bank offers you lower interest rates, they also offer you better monthly payments and some other benefits with this, maybe some cash back with your new mortgage, and even offering you the mortgage processing fees to be waived, then you got a pretty good deal and you don't want to lose it. On the other hand, if you don't get the bank processing fees waived, then it might be quite a hefty sum that you need to pay for the switching. So you need to consider if this offer is actually good enough for you to make the switch and make all those relevant payments. Because let's say if you're switching from a 5% annual interest mortgage to a 4.9, then maybe that small difference in the interest won't actually matter, because you would be paying a lot of other bank processing fees, valuation costs, and so on. However, just do your calculations right and always ask your banker for the monthly calculations, which basically includes the EMI payments for every month, where you can see what's the principal and also what's the interest applied to that. If it's a fixed mortgage, then it's very easy because it's going to stay constant at the same price or same cost for you every month. And you will see the breakdown of interest and the principal, which it makes it very easy for you to assess it and decide whether it's worth it or not. Finally, there are also many other bonuses that might come along with these new proposals from these banks. For example, if you're looking to get an auto loan, then the new bank might offer you that you get this new mortgage, so refinance your current mortgage and get a better rate for your auto loan if you get it with the same bank. So just make sure you ask the bank that you're thinking of switching to if they have any alternative and complementary offers, because many banks do this and they might even not tell you because you're just simply interested to get it without any of those benefits. But make sure that you ask them for this and not lose out. Now, the last and most interesting benefit for a property investor out of the property refinancing process is obviously taking some equity or simply cash out of your property, because during some time your property already increased in value due to many reasons. Could be the market going up, could be that you actually furnish the property and you put some very valuable items inside, and now the market value of this property is higher. So the bank may actually assess it on and evaluate it on a much higher rate and be able to offer you some cash as a new form of a loan. This could work even if you don't have any property mortgage or if you already have a current one. So in case you already have a mortgage, then you would be able to just do everything that I mentioned previously and benefit of those, but also you'll have the advantage of asking for some money to be paid in your account and changing the amount of your loan and payments, of course. So basically you benefit from your property increasing in value, and getting some money out of it. I know this might sound difficult, but let's take it step by step, and there are only 3 steps which can explain you how this actually works. First, let's take the loan against the property value. When you do a cash out refinance, you take out a percentage of the property's value as a new loan, even if you don't have a mortgage on that property. If the property value currently is, let's say, 1 million dirhams, then you are eligible from the bank to get, in a case of 80 to 20 LTV, 80% of that value in a form of a loan. Then secondly, you receive the cash for this equity, which basically means that you're receiving that 800,000 or 80% of the current value in form of actual cash in exchange for that equity in the property. In this case, I used an example of 80 to 20 LTV, but that is usually the maximum that a lender would offer you and be able to get that in form of cash. Easier to understand and put it in words is basically the bank is buying that 80% from you and is giving you a cash loan based on their new terms if you have a current mortgage, or just the terms that they have in exchange for that 80% equity or lower. At the end, you remain the owner of those 20%, the bank is owning the 80%, and you have the cash in your bank account from the bank, and you have to repay it on the 3rd step as a new mortgage and new monthly payments. Since you'll now have a new loan balance of 800,000 dirhams, the banker will give you a calculation of the EMI or monthly payments, and you'll have to start making those monthly payments starting with the next month. The interest rate and loan terms obviously depend on the lender and your credit worthiness, so it depends literally on what's your profile with that bank specifically, and you can access better or worse terms with different banks. So just make sure you assess all the possibilities in that market where you're looking or where you're based in, and choose the best one working out for you. This strategy is really, really popular among property investors, and I personally used it as well, and mainly for funding newer projects, new investments, maybe fund the renovation of this or another property. Usually in different markets, there are different rules towards getting the cash out of your actual existing property. In UAE, for example, you need to have another property so you can actually take that cash and say that this is the reason that I want the cash from you. So basically explain to the bank why you need that cash in your bank account in forms of a new loan or just a property refinancing on your current existing mortgage, so that they understand that you're not just taking that money to run away, maybe move to a new country and just live happily there. Basically, the bank needs to be sure that you will take this money from them and you will still start paying those monthly payments, and make sure that you will be actually able to commit to them and not miss any of them. And by the way, I strongly recommend you to never miss them because the charges might be significant. Hopefully by this time you understood better what a property refinancing means, what are the main benefits, and also how it could be applied as a cash out refinance. And by now you understand that it's actually possible even when you don't have a mortgage, even when you just simply own a property, and why you can use this strategy to fund some of your newer upcoming projects and profit from leveraging other people's money, and in this case, leveraging the bank's money. I personally always use this strategy in my home country, in Dubai, where I'm based currently, because this is a pretty easy strategy to make sure that you don't invest too much of your own money, leverage the possibilities that are around you, and make money on the bank's loans that are available for you, Obviously, there are different requirements and terms in different countries. Here in Dubai, it's actually quite hard to get a loan. However, if you're able to do so, I strongly encourage you to do this strategy, specifically if you want to build your property portfolio, if you want to add more properties. You can even use this money to basically buy yourself a holiday, and another part of it, make it as a sum towards a newer investment. So there are different ways to go around this. And anyway, if you're interested to find out more, drop your comments. I will read everything and try to answer as detailed as possible. I hope you found this video useful. I try to make it very generic, basic, but also with some actual real life examples. So I hope you actually understood how this works, because this is a very, very important concept and not many people actually get it. So with that, I hope you have a lovely day going forward. Leave a thumbs up and subscribe to see more of these videos. See you in the next one.